Hello and welcome back to the MCF Participant Education Series. I'm Hunter Nybert. Today we're going to be discussing market volatility, and hopefully you'll come away with a better understanding of what normal market volatility is, as well as strategies that you can lean on during turbulent times in your investment accounts. You know, in life what you focus on can make all the difference. Take a professional baseball player, for example. Standing at the plate, a player has less than 0.45 seconds to react to a 90-mile-an-hour fastball. And during this time, they have all kinds of decisions they have to make in less than half of a second. Where the pitch is located, how fast it's coming, what kind of pitch it is. And they have to do this with 20 to 50,000 people causing confusion, yelling at them. And these distractions are designed to try to throw them off of what their main focus is. And distractions come from the dugout, situations on the field. How are these guys able to perform this task? Well, the answer is simply through selective focus. A successful hitter learns to tune out all the noise, all the external distractions, and focus on the one thing that matters, and that's the pitch. When they're able to do this, it narrows their focus so much that they can react in an appropriate time. And investing is not that much different. There's all kinds of things that happen in our investing daily lives that really serve as short-term distractions. But there's good news. Investing with a long-term focus is a powerful and effective way to prepare yourself financially for retirement. Consider in the following example. If you invested $1,000 in the S&P 500 from 1985 to 2014, you would have generated returns ranging from negative 37% to positive 38%. But over that 30 years, your $1,000 would have grown to be a little over $25,000. That is amazing long-term focus. If we worry about every dip in the market that it happens, we'll drive ourselves crazy with what's going on in the real picture and the long-term focus of our retirement account. The next chart shows the S&P 500 since 1980 and illustrates the intra-year market declines within. So what you're looking at is the gray pieces on this chart are where the market finished for that year. The red dots below are where the market was in negative territory at some point in time during those years. What's important to note is that the market was down on average 13.9% every year since 1980. That's a pretty good swing considering that the market finished in positive return for 29 out of the 39 years. So how do we not fall to the making bad decisions during volatility? Well, the biggest thing is to avoid a herd mentality. Now, what's a herd mentality? Honestly, it's just following the crowd, sometimes irrationally so. So if the market drops, let's avoid knee-jerk reactions and focus on the long term. Don't abandon good investing principles. What I mean by that, let's not try to time the market. If timing the market was a good philosophy, it would have been proven to work and beat the market. However, a recent Dalbar study in 2013 shows that herd mentality and herd behavior lags the overall market by 4% a year anyways. And then as always, I would always recommend that you reach out to an advisor as a resource if you have concerns about capital markets or downturns, and discuss where your risk attitude is and go from there. How many of you have observed friends or family who have tried to time the market to their own advantage? Did it work out well for them? Did it not? This slide here shows the power of staying invested. If you'd invested $1,000 in the S&P 500 from January 05 to December 2014, so almost a 10-year period, you would have made 70% if you had stayed invested. So your $1,000 would have turned almost to $1,700. If you had missed just the 10 best days, your account value would have been down 14%. And that's not 14% from what you had made, it's 14% from what you started with. If you had missed the 20 best days, you'd have been down 44%. If that's not an illustration of the power of staying investing, I'm not sure what is. What if I told you there's a way to ensure that you're buying more investments when the prices are lower without having to predict the future? Well, it's true. It can be done through a process called dollar cost averaging. This is just a fancy name for the process of investing on a regular basis. Now, the chart here is an example of a person who invests over a 2-month period on a regular basis. They are investing $50 at a time. The share prices were between $10 and $25 over this 2-month period. The average price paid per share was $16.67, but the average share cost was $18.75. Keep in mind that if you're participating in your company's retirement plan and you stay invested and stay participating, you will be dollar cost averaging over your lifetime, which means that your average share cost will be lower. And that's kind of the name of the game. Let's look at another benefit to investing in the long term and not trying to time a market. Inflation. Inflation is real. Who remembers what the price of gas was in 2002? I do. It was $1.11. And the only reason I really remember that is because just a year and a half before that, I was learning to pay for gas on my own. As I drove here today, the price of gas was almost $2.60. Inflation occurs everywhere in our lives. Food, beverages, housing, apparel, transportation, healthcare, and medical cost has been rising very rapidly. If we choose not to stay invested in the markets, then we risk inflation making what we've saved weaker. So the only way to pace inflation over time is to continue to stay invested. In conclusion, let's avoid common mistakes that many investors make and remain disciplined to reach our long-term goals. Stay the course and don't try to time the markets. Stay investing and use that dollar cost averaging to your advantage. And lastly, take advantage of resources that are available to you. If you have questions about your plan or something individually or want to seek advice, reach out to us at MCF. Here's my contact information below. The single greatest edge an investor can have is long-term orientation. So let's stay focused on the long term. Let's manage our risk where appropriate and not make rash decisions in the short-term turbulence of a volatile market. Thanks for watching today. I hope you got something from it, and I'll see you next time.